The rules of investing in Kenya are shifting. Capital is being repriced, risk is being redefined, and discipline is becoming more important than ever.
There is no free lunch. If you're seeing a free lunch, think twice.
So today we're asking one key question. Where should smart money be paying attention right now?
I've seen clients now opening minor account, starting a small investment for the kids, building for the next generation.
Chase the goal, and the goal will define the return. I'm with Charles Miano and Moses Njuguna. Welcome to the roundtable.
Thank you.
Yes, I'll allow them to introduce themselves.
Yeah, thank you very much. My name is Charles Miano. I serve as portfolio manager here at Nabo Capital. I'm looking forward to the roundtable.
Thank you. My name is Moses Njuguna. I work as a private wealth manager here at Nabo Capital. Excited for this opportunity. Thank you.
Okay. To start the conversation, I'll ask the first question. What investment belief could cost Kenyans the most money in 2026 for both Charles and Moses?
Yeah, thank you. That's a really relevant question as this year is looking quite promising. If you look at the capital markets, as at this particular time, the market is up over 15% year to date. That is the Nairobi Securities Exchange. Yields are dropping, and whenever yields are dropping, that means that bonds prices are going up. And we can see a lot of dynamics shifting, and particularly if we focus over the last 5 years or so. So we came from a period where there was COVID-19, and during COVID-19 the markets were quite depressed. And post 2022, where we saw the Russia-Ukraine invasion, we did see that we saw inflation spike up. Inflation spiked up, interest rates went high. Our CBR rate, which is the central bank rate, rose as high as 13%. And bonds went quite high. The government listed, particularly, there was a bond in 2024 that was listed, an infrastructure bond, which is tax-free, was listed as high as over 18, almost 18.5%. And now, since 2024, we've seen yields come down. So what that means is there's been a shift. That shift means that when the capital markets, particularly equities markets, were depressed over that period, since COVID into 2022 up to 2023, we've seen now a resurgence. In 2024, the market was up about 34%. In 2025, the market is up 51%. So I think one of the things that Kenyans can absolutely not miss is looking at what's happening in the capital markets. And also something that is new and emerging is the infrastructure, the digital infrastructure that is coming. As of this week, we've heard of the ZD Trader, and that has democratized and allowed normal Kenyans to come in and buy assets in the capital markets. So I think this is a situation, this is a place that Kenyans cannot miss in participating. And also we now have an IPO that is upcoming, so I think it's quite relevant at this particular time.
Okay. Yeah. Thank you, Charles. Just before I allow Moses also just to answer that question, what does it mean when it comes to monetary policy? We've just seen CBK have reduced the CBR rate by 25 basis points. What does that mean for the economy and also the outlook in 2026? And what does it mean? Do you expect also to go lower than that?
Okay. Yeah. So the CBK cut rates. So by cutting rates, it means there's an intention for there to be low interest rates. So what does low interest rates mean? It means that borrowing will be cheaper. And so what we've seen, an actual impact is we've seen private sector credit growth go up, currently at around 6% or so. 1 year ago, that was January 2025, it was negative 2%, meaning that people were not actually borrowing money. So the rates are going much lower. And that means that we will see more credit being taken up. With more credit, there is more money in circulation, more money in circulation means there's increasing demand. When there's that increasing demand, there's more consumption, and hence the economy can grow much further. So the intention is with these lower rates that the economy grows much faster. We expect it to grow by about 5.5% in 2026, about 5.6% in 2027 by the central bank. And I think this will be a way to facilitate that. And the second thing is, as interest rates come lower, we expect the government to borrow, the borrowing to be much cheaper. The government borrows quite heavily, and I think our debt to the GDP is about 60 to 65%. So if you're having that level of debt, you want it to be a bit cheaper. So I think that will facilitate cheaper debt, which now government can use to finance that. And lastly, you've asked on what the outlook will be. We expect further cuts over time. We expect rates to go as low maybe from 8.75, maybe by the end of the year around 8%. So that is the expectation, and we're seeing same thing across the globe where interest rates are being cut in different countries.
Okay.
Yeah.
Moses, you interact with clients almost every second.
Yes.
Where do you think your clients will put their money 2026?
Thank you. The client we have, and every client is unique, and they come with different needs. And as my role as a financial advisor is always to assess. To assess first, I assess their risk profile in terms of their risk capacity, and then I assess the asset classes that are there. Because somebody may come and say, yes, I want the high return, but high return is not always the thing to define a good investment for that client. I go beyond and see the suitability of that investment. So the good opportunities, like what my colleague Charles has mentioned on the equity market, of course, we have the alternative opportunities like the I rates. These are new opportunities that are coming in the market. This would be a good asset classes, but we'll have to allocate it to clients based on their profile, on their risk profile. So to avoid a situation of where, because what we have seen in the market, people mostly they trust the rumors, and where they feel this is where the money is being made, they react. We tend to move in numbers and go into that market, and sometimes the returns you are looking for, yes, you may get, but maybe you don't have the capacity in case of a risk on the other side. So where people will make money, I would say this will be informed a lot by, risk analysis of these clients, and also their capacity, and also level of sophistication. There are those who are very high level sophisticated investors who fit into a different asset classes. So as Charles says, we have the funds that are geared towards this, managed by professionals. So as I do the allocations, I'll be guiding this client based on the risk profile.
Okay. Just still with you, Moses. Just a follow-up question. We've talked about return, and we've seen the markets changing. We've seen the CIS space as of Q3 2025 hits 0.7 trillion. Where is the market overconfident? As on the client side, from where you sit, where is the market overconfident?
There is a shift, and I'll look this from, if you look even from the bank deposits where the investors have been before. Information penetration and how people financially trust was, it was a bit scarce. But there has been a financial information, or what we may call deepening, where clients are continuing understanding, learning from us in the market. We're educating the members of public, and there's a shift whereby people are not just parking their money in the bank, but now they're moving to the investment. So as you look from the dynamics or the numbers, people, for how they used to keep money idle in the bank, these numbers are changing, and people are moving to the investments. Investment has become simple, and people are able to understand the simple basics of investment, and people moving to like money market fund, where we've seen it that as the funds growing, and if you look, part of that people, most of them coming from the money that were just idle in the bank, but they are people understanding you need to earn a return on every money that you have. So as you move now to these investment classes, we are looking on how well, educating you about the risk, managing your portfolio, and keeping on increasing, maybe moving you to equity funds, moving you to alternative asset classes like the I rates, and also different fixed income assets. So we are able to keep on growing this, but of course aware that people sometimes chase the return and believe that this is the only thing they are looking. So we are there to make sure that we educate the people. It's not just the return alone, but look on the diversification. How are you diversified as you're coming on this side, in terms of sustainability, not just a transaction whereby you come in, just put your money, then you move. No, look at it having a long-term view, 5 years, 10 years. So we are coming on this side of the investment and guiding these clients so that they can build sustainable wealth.